I'm Jesse Mackey, CIO of 4Thought Financial Group, and this is 4Thought's Market Perspective as of November 23, 2021. Yesterday, the S&P 500 index reached a new record intraday high, and as of the close of business, has now experienced additional gains of 28.44% since the point of recovery from its last 10% plus correction, which was a little over 1 year ago, on November 9, 2020. Across all asset types, U.S. small-cap stocks and global private equity are the best performers year-to-date, while U.S. aggregate bonds show the worst performance. Most stock types, with the exception of emerging markets, continue to outperform bonds by a wide margin so far this year. Historical data indicates that once a new bull market has been confirmed, which happened on August 18th of last year when the S&P 500 index had recovered from its March 23, 2020 bear market low point and achieved a new record price, the longest time period on record since 1950 before the beginning of another bear market was 7.44 years, with an average of 2.44 years. Only 1.27 years have elapsed from the point of bull confirmation in this instance so far. There's usually been at least one 10% plus correction, but often several between most bear markets in history. The average time between the end of one correction or bear market and the start of another is a little over 1 year. The first correction in the current bull market was completed 1.16 years ago on September 24th of 2020. We like to refer to the combination of a correction and its corresponding recovery, which was registered on November 9th of last year, as a wolf market. Our data set also tells us that about 55% of wolf markets like the last one we experienced have been followed by a period that exhibits trailing one-year returns of 30% or greater without a 10% plus correction, something we refer to as an eagle market. The first eagle market subset of the current bull market was quantitatively confirmed on March 1st and has continued since then. Once an eagle market like the current one has been indicated, it continues for an average of an additional 5.35 months. This instance has continued for 8.9 months so far, which puts it above the average duration. Eagles may be followed by any of the other three market types, including a flattening of growth rates to return to a standard bull market or an immediate reversion into a wolf or bear market. Given that stocks may still be relatively early in the traditionally defined bull portion of the market cycle by historical standards, an immediate bear market, although certainly possible, appears the least likely of the various scenarios, while a 10% plus correction is becoming increasingly likely in the short to intermediate term. Based on analysis of the complete historical market type data set using our multi-method adaptive algorithmic process, we're now allowing overweight allocations to opportunistic investing, neutral allocations to strategic asset allocation and liability-driven investing, and underweights to selective concentrated investing. From a probabilistic analysis perspective, valuations tell a story that's relatively negative for most stock types and more favorable for portions of the bond markets. On this basis, stock types range from near fair value, in the case of emerging market stocks, to moderately overvalued, in the case of U.S. large-cap stocks. Bonds range from moderately undervalued, in the case of long-term U.S. Treasury bonds, to near fair value, in the case of Treasury inflation-protected securities. Long-term U.S. Treasury bonds now reflect the most attractive pricing relative to the alternatives, while U.S. large-cap stocks are the least attractive. Against this backdrop, the outlook for stocks is now slightly negative in the short to intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. I hope this was helpful. If you have questions or you'd like to discuss what this means for your particular situation, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and our YouTube channel. Thanks for watching, and see you next week.